Well, Melissa, it's interesting. After 4 straight weeks higher and the S&P up 17%, NASDAQ up 23%, I think we were all expecting there to be some consolidation and the market to take a break. But the fact that we pushed through from lower to higher right now shows that there are plenty of people out there interested in buying, even after this gain in all of the indices. And that says something about the resilience of the market and the fact that the Fed may really be cutting back on its aggressiveness. Inflation may really be coming down. We see that WTI, meaning the price of oil, is back under 90 today. And so people are feeling better about the second half and looking forward into 2023 in terms of earnings momentum. And that shows that perhaps we can carry this rally further. Even if there's some consolidation, we feel it's unlikely that we go back to the prior lows of June 16th, and that we're more comfortable paying up for stocks if interest rates are not going to continue to rise as high as was expected.
Yeah, on a Monday morning like this is at an interesting crossroads, and we mentioned that 50% retracement at the top. Strategists are busy over the weekend putting out their notes, and today we got some very, very differing views from a Morgan Stanley, Mike Wilson, who is on this program in the network very often. I don't want to say perma bear, but he has a bearish view in the market, and JP Morgan, which has been very bullish on the street. And I bring these two opposite points of view up because it really underscores, Joe, the confusion on where the markets could go next now that we're here sitting, off of this tremendous run from June lows. What do you think?
Well, I think it's important to focus exactly on that, where the market could go. And all indications to me from certainly a technical perspective is that both the S&P and the NASDAQ is clearly targeting the 200-day moving average, which sits slightly above where we are currently. Kari mentioned the resiliency in the market today, but overwhelmingly coming out of the month of June, there was this extreme pessimism, and there certainly was an underweight towards the growth strategy. There was an underweight towards the growth strategy because there was this expectation that any form of moderation in inflation would be difficult to achieve. Well, you're getting that through an economic contraction. Quite candidly, the weakness in China is going to help the efforts of the Federal Reserve combating inflation, because you're going to be importing those deflationary pressures from both China and Europe. So, Melissa, growth is coming back as a strategy. You're seeing that both institutional and retail investors are rebuilding positions there. And that's a significant catalyst for the market, with growth being over 40% of the weighting of the S&P 500. So I think there is more upside potential here. I think what Mike Wilson is speaking about in his note is obvious to all. We know that on September 1st, the balance sheet tightening is going to increase. It's going to double in size for treasuries and mortgage-backed securities. We know that in October, we're going to hear about the challenges towards earnings. We know that oil has a fundamental concern that you push into the fall. But for the moment where we are right now, the technicals are clearly pushing us higher towards that 200-day moving average.
Sure. On the going forward part, though, Mike Wilson also underscores the notion that the setup for equities just isn't as good as it had been before, from a policy perspective, from a rate perspective, from an earnings perspective, Steve Weiss. And I go to you last because, speaking of underweight, I mean, you're basically underweight equities, period, in your portfolio.
Yeah, I've actually, I'm sort of disappointed in you, Mel, a little bit.
Why?
That I know every day
we're 4 minutes
look
into the show and you're disappointed in me already? I mean, you're welcome.
Yeah, I know, Mel, first of all,
never
join the club.
First of all, Mel, it's a low bar, Mel, first of all. But look, every day I know you look at your inbox and you search for my name to see what I sent you. And today, what I sent when the market was looking down was that, hey, I wouldn't be surprised to see the market move up, because the focus will turn to the fact that energy is down again, meaning that people will think that inflation is going to continue to decline, and that China is stimulating their economy by cutting rates by 10 bips. So this is a glass half full market, which is why I added meaningful equity exposure. Now's not the time you have to worry. Where you have to worry is you get in September, October, and the rate increase that we've seen in the U.S. start to take effect. People just aren't doing their work. Well, everybody talks about this is a much better earnings reporting season than what people had expected. It's just not true. If you take out energy earnings, actual earnings were down 3.7% without the Fed hikes taking effect. Revenues weren't blow away. And in fact, the beats, the surprises, the upside surprises were below the 5-year average. So when you're in a rate tightening environment, as we've seen over the last couple of months, you don't get multiple expansion. So that's temporary. Now, I agree with Kari. I don't think we're going to test the old lows. She said we won't revisit them. I don't know if we do or not. But right now, I'm still playing for the market to continue to advance higher because I think that it will. Have added some more exposure, bought Skyworks back, which I haven't owned for a long time. And that's more of a trade in semis. So, look, as I said, the market's going to tell a different story. We're seeing headcount reductions across the board, not just at Microsoft or Alphabet. We'll see them in other places as well. And it's just not so easy as it seems to be. There are, I think, troubled waters ahead. So right now, don't worry about them. But come September, October, typically difficult seasonal times for the market, you could see a different story.
Time out here. Time out here. Weiss, when you say meaningful exposure, you added meaningful exposure. What does that mean exactly?
Well, that's not a new story.
Say.
You know, I've been there for, you know, it may be new to you, Mel, and now you're really hurting me. So you haven't been watching my clips over the last couple of weeks since
I'm
you were last
a little behind.
on.
I've been watching Kari's clips instead.
Yeah, well,
pretty good.
You should be watching them both. Enough said. Look, you know, right now I'm close to 70% invested,
Okay.
and a lot of that comes through indices, through the Qs, through the SMH. Although I shaved the SMH a little bit, not much, but it comes to that. But also I have added Deere, which is down a little bit today, Devon, and before people say Weiss says energy is not investable, yet he's bought into it. You know what? There's not one energy fund that's up over the last 10 years. So it is uninvestable, but it's extremely tradable.
Yeah.
So Devon, natural gas play, 50% oil. So that's why I'm there. I own a little enterprise, actually, for the yield and for not having done much.